So I think let's just start, I guess, as
Yeah,
promised.
let's get started. Yeah.
All right. So hello, everyone, and welcome to our exclusive webinar titled Emerging Markets Unveiled, Navigating Global Trends and Opportunities in 2025. I'm Manisha Jain, your moderator for today's session, and thanks a lot for joining us. So one of the key principles in investing is diversification, which means spreading your investments across different uncorrelated assets to reduce risk. This idea is supported by the pharma French efficient market hypothesis, which suggests that it's impossible to consistently achieve higher returns without taking on additional risk. By diversifying your portfolio, you can find a balance between risk and reward, ideally positioning yourself on what's known as the efficient frontier, where you can maximize returns for a given level of risk. Global markets have been dynamic in nature, and lately volatility can be its epithet. For instance, the tech stocks rally, largely due to innovations in areas like AI and cloud computing. However, other sectors like energy, industrials, utilities, consumer discretionary have all faced some challenges. Multiple researchers have proved beyond doubt that it is impossible for any investor to perfectly time the market and rotate into the best performing stocks or sector. This underscores the importance of diversification. By investing in a range of sectors, you can protect your portfolio from downturns in any one area, while still capturing upside in the areas that are doing well. So say, for example, in the US, the tech industry continues to thrive, attracting significant investment. But as an investor, it's crucial to look beyond just one country or sector. Emerging markets, particularly in Asia, are also worth considering hence. These regions often have growing economies and increasing consumer demand. However, they come with their own risks, such as political instability or currency fluctuations. This is where your diversification can help. By investing in a mix of established and emerging markets, you can balance potential growth with the risks involved. As we navigate this complex market, remember that diversification is not just a strategy, it's essential for long-term success. By creating a well-diversified portfolio that aligns with your financial goals and your long-term success is how you can accomplish this. Without much ado, I would also like to let you know that we are in our constant endeavor to keep our partners and clients engaged and abreast with whatever is happening across the globe and make these decisions of having optimal allocations. This is one effort in that direction. We have a fantastic lineup of speakers today who will share their insights and expertise on these topics. So as promised and as communicated already, we have with us Ashish Chanda, our group founder, CEO, and CIO. He comes with over 2 decades of experience across the globe. And we really would be very delighted, Ashish, if you could throw some light on the recent global market trends and developments. So over to you, Ashish.
Thanks, Manisha. So just an overview on global markets as we speak about. So when we talk about global, I think the two main countries that we talk outside about India, of course, are US and China. And while there is a much broader global emerging markets play at hand that we should all go into, but I'll leave that to our colleagues Sujit from Arga. But in terms of the overall global markets as we speak about, the most interesting factor that we should look at is how the GDP growth as well as the interest rate markets have moved over times. GDP growth, because that is important to understand how the economies and how the equity returns will function. And interest rate markets, because what happens typically is that with equity investors, or that if you are not looking at the global macro scene, you miss out on the overall trend, the broad trend that you are kind of going to get, because the interest rate cycles pretty much define how the markets are going to behave across EM, DM, US, China, and so on. So like the chart that you see or the table that you see over here outlines how the returns in equity markets, which is the broad indices of various countries, have fared, in 2024 or 23, and of course 2022 though was a bad year, but then typically you can see what's happening now. So what's interesting to note over here is that there are certain markets like let's say the US, which have had a very consistent performance over the last 2 years, but not a very strong volatility in some sense. Because volatility, whatever said and done, has been very below normal, just because you see that the interest rate have been quite supportive to whatever extent in the last part of 2024, let's say in the last 3 to 6 months, based on the views and interest rate cuts that we got from the Fed. But if you go back like 6 to 8 months, it was a very volatile time in 2023 and 2022, where the markets were very susceptible to, are we looking at a recession? Are we looking at inflation? And there's a war going on in Russia, Ukraine, and a lot of political instability in Middle East and in the China Taiwan region, and that kind of had an impact on total markets. But the technology innovation that you saw that happened in the US was really very sacrosanct. But now we've reached a stage where it's important for us to figure out that the new interest rate regime that we are in, because for the last, let's say, about 2 years, we were in a regime where it was more inflationary, but now we're talking about is it going to be inflation again or more like a recession, and hence lack of inflation, or what kind of regime we are in, and we can discuss more about that as we go in. But based on that, I think what is the most interesting now is how are emerging markets going to react. Japan is in a different interest rate cycle. US is in a different interest rate cycle. India different. China different. And there is, of course, monetary stimulus and fiscal stimulus, which is very different in different markets. So I understand that all of you are not tracking all these markets. Overall, but I think it's important to benchmark how the overall market capitalization is working, and the returns hence are working, based on the GDP and the market value. So market value to GDP is a very important factor that everyone from Berkshire or Warren Buffett and most of the people track. Where I would say on just that parameter, which is market value to GDP, China probably comes out as a much more value, but it has been value a lot for the last, let's say, about 2 years. But something is changing there. And I'll defer to my colleagues at Arga to talk about it. But what's happening in the US is a big divergence, right? And while there are months where the divergence goes down, but the divergence is very stark, where you see that the US Mag 7 or the overall index has literally shot through the roof, and which is carrying the weight of the rest of the, let's say, 493 stocks. And that's something that is quite significant. And there are parallels to draw between this and what happened in 2000 or what happened in 2007. And that's something that we should always keep in mind when we decide how much allocation to do in, let's say, US or Japan or China or other EMs, and go into that. So if you just move ahead, we can just look at what the overall performance across various sectors is. But I would just maybe take a pause and open it up to Sujit and see if he would like to add something here, because I do want this to be more of a multiple log rather than monologue here. So Sujit, maybe over to you if you want to just talk about, set the stage about what the macro views are, how Arga thinks about various markets, or Manisha, you tell me if you want to like kind of make it more like a roundabout panel. Yeah.
Absolutely.
Yeah.
I think we would love to hear from Sujit. And yeah, at the onset, of course, I missed the chance of introducing Sujit to all of you. So P. Sujit Kumar, he's the Global Business Analyst and PCT member at Arga Emerging Markets. He's been with Arga since 2010, and the kind of performance and recent, focus that has come on the fund speaks volumes of the kind of research and that the specialized way of approach of picking the underlyings is what Arga follows. So Sujit, very warm welcome to you all, you and Pankit. So Pankit is also present in our panel. He's the director for of client relations for Arga. So both of you, a very warm welcome. Thanks for taking time out and making this an event where we can all discuss all about the globe and the kind of opportunities which lie ahead in the emerging markets. So here we would like you to add some color and help us understand the correlations, or so to say, any divergence that you would want us to be aware of. So
Yeah, so,
thanks.
certainly. So maybe I'll use this chance. Thank you for having me here. It's a pleasure. And I'll maybe talk about, so we are not macro experts as such. We are business analysts, and we do deep research into industries. At Arga, we have about 110 plus global industry models and industry frameworks. Clearly, there are some macro assumptions that go into those models, but what we would go with is consensus. It's not our area of expertise. We wouldn't expect us to have a much better hit rate in the macro forecasting compared to you. But where we have clear views and our process really works well is using a single focus in terms of investing in undervalued businesses, right? So valuation upsides is what we try to get right. And in that context, today you've shown what has happened historically, but that sets stage for what's likely to come in the future. We agree that valuations in the US have reached, towards the multi-decade highs, relative valuations especially. And usually when you have valuations on your side, that's when the next, decade of returns are going to be a lot more favorable. So yeah, sorry, Ashish, go
Yeah,
ahead.
so I just wanted to maybe set the stage, right? So say we are more of asset allocators, or where we decide between EM, DM, fixed income, macro, and so on, right? Various alternates. So basically, what we have analyzed and what I've personally seen in my 20 to 25 years of being a trader, portfolio manager, and so on, is that when you have an interest rate cut cycle in the US, right? People think that that's going to impact or be much more beneficial for US. But the reality is that when you have an easing cycle in the US, it's the emerging market currencies and certain emerging markets that do a lot better. Now, of course, which ones I would let you give your opinions. But if I were to set a stage, I would say that if there is a time to look at emerging markets, it's now when the rate cut cycle has started. And tell me if that's kind of consistent with your analysis. And assuming that we believe that analysis, which the data has shown over the last 2 decades, what should we look at? Because if I go by just historical returns, I mean, markets like China or overall EM, whether you take Brazil or other countries, right? The returns have been quite subpar, right? Let's accept that in certain countries in terms of the multiples and so on. So there's definitely more value probably there. So just want to get your perspective on
Yeah.
whether it's return, whether it's valuation, and how does it tie in with the rate cut cycle? Because I truly believe that rate cut cycle should impact emerging market currencies, and emerging market equities a lot more positively. But that's a very big universe. Where should one look at, and how should one think about it, and what's changed?
Certainly. So yeah, that's a great point. I do agree with you that a rate cut cycle in the US is broadly positive for emerging market equities. You brought up Brazil, right? Interesting. You can see what's happening there. Brazil interest rates today are in double digits. Recently, central bank has started raising rates again. Now, with those type of interest rates, the burden on low income households to manage their budgets is tremendous. So as a result, many sectors like consumer discretionary, you can take food retail, um, even those companies are depressed because they're seeing declining revenues. Consumers are pulling back on spending. There's broad weakness. And when US starts cutting, it relieves a lot of pressure on central banks around the world, especially on emerging markets. And also the capital flows matter a lot for inflation in these countries. And you have, it's broadly positive for commodities, etc. And you have emerging markets. There's multiple countries that benefit materially when commodity prices go up. So there's a lot of tailwinds. So maybe if it's of interest, I'll go through a few slides to actually show the valuation discrepancy that we see today, and why we are excited about emerging markets at this stage. So yeah, I mean, so,
Also, Sujit, if you could touch upon, China specifically, and the reason I ask is because in the last, let's say, about 3 weeks, it's
mhm.
been from a 52-week low to a 52-week high, and then back in the middle, and then there's a lot going on over there. It's probably people reacting to the news and the stimulus and everything. So within the emerging market segment, how does China fit in, and what is the key thing that people should look out for? And if China does become the next big thing, what does it mean for India? It would be good to just understand your perspective on these, since you kind of see straddle these emerging markets, of course, along with the countries like Brazil or Mexico.
Certainly. Just quickly, before we go into the country level dynamics, right? So when investors think of emerging markets, they think growth investing. They think of growth investing. It's what works. These are high growth economies. But the reality is, if you had bought the cheapest quintile of companies in this universe on a price to book basis historically, so this blue line would tell you how you would have performed versus the average stock in the universe. So there's material outperformance that you could have accumulated by following this philosophy consistently in emerging markets. There'll be years of pain, clearly. So that's why, I mean, value investing does not work all the time. That's why it actually works well over time. And you have a longer period of underperformance here over the period of 2011 to 2020, given declining interest rates and very low interest rates in US and various countries across the world. It proved to be a headwind to value investing, but we have seen that reverse in a material fashion over the last 3 years. And if you, where we are finding opportunities today is broadly, you can see here where valuations are still attractive. And if the blue dot here tells you where current valuations are versus historical range in terms of price to book compared to the past 10 years average, the range and the average. You can see here emerging markets, and especially China. Within emerging markets, China onshore and as well as offshore are the most attractive in terms of valuations. And Latin America emerging markets is also very attractively valued, unlike US, where it's trading at the peak valuations, or other developed markets too, which are well above their historical average in terms of the multiples. And one interesting other dynamic that I want to show is historically, if you look at, the cyclically adjusted P has been a good, indicator of how likely are you to do well over the next 10 years in a given market. So if you buy markets or stocks enter into different areas when cyclically adjusted P valuations are very low, that would indicate, a chance to outperform, do materially well over the subsequent decade. So to see where we are in emerging markets, Cyclically adjusted P is nothing but you take the last 10-year earnings, take an average of that, and compare it with the current market cap or the valuation of the business. So you're taking a through cycle average earnings and seeing how cheap are current valuations versus that number. Emerging markets are trading at towards the low end of that range, whereas US is at the highest it has ever been in since over the past 2 decades or so. And as a result, if you see what does this mean, right? So this light color blue line is what were the 10-year annual average earning returns you made in the market at that point in time if you're invested in that market. So in US, if you entered the US market, you would have made close to 11% per year over the subsequent decade because the cyclically adjusted PE that you're buying at that point in time was still very attractive at close to 20 times. Whereas today we are at 33 times cyclically adjusted PE. So this the right hand side vertical axis is inverted, and this is close to the levels we have seen in during the dot-com bubble, where the cyclically adjusted P in the US market was close to 35 times. So if you had bought US market at that time, your returns, annual average returns for the next decade were negative 3% or so. and and this has been a good relationship historically. Obviously we are not going to be able to say with certainty you'll also see minus 3% returns over the next decade, but it just tells you why valuations matter and what has happened. The best period to buy the US market was during the '09 to 011 period, when you had the cyclically adjusted P in close to 12 times, the best ever valuations the market has seen over the past 25, 30 years. And that's when you had seen 13, 14% annual returns for the subsequent decade. Whereas if you come to emerging markets, this is where we are today. The blue line on the right side indicates the current valuation level. The P ratio is 10 times. And this is similar to what the valuations were during Asian financial crisis and post the US.com bubble. And you would have again seen double-digit returns for the subsequent decade per annum if you had bought emerging markets. And what we have seen more recently is nothing but, lot of things were going against emerging market investors in the last decade. So if you look at the growth differential in GDP between broadly emerging markets versus developed markets, that was accelerating during most part of the period between 2000 to 2007. And this is the time when you got these double-digit annual returns in emerging markets, whereas US market would have given you, on average, negative returns during that decade. So material outperformance, right? But because of some of the excesses that were created in certain economies, especially China, we had seen the growth differential narrow for over a decade, and that impacted the relative performance of the markets too. Clearly, you had a lot of things going right for the US market, which I'll talk about in a second. But finally, we are seeing a bottoming out of this growth differential. This dotted black line is giving you the GDP growth differential between emerging markets versus developed markets. It's starting to pick up. And that's a tailwind. So when you have your economies growing faster than developed markets, your earnings are likely to grow faster, and that would lead to better valuation outcomes and better returns going on a go forward basis. And if you see one of the issues with the US market, right, the profit margins of S&P 500 companies, if you take out financials, etc., where for comparability basis, you can see REITs and financials have been excluded. The profit margins are at close to the highest levels they've ever been over the past 75 years. And why are we here, right? So there's a lot of good reasons. Companies have gotten more efficient. They've outsourced a lot of their costs to lower cost regions. But the biggest improvements came because of interest rate declines as well as tax cuts that US companies benefited from. And the third biggest bucket is from globalization and offshoring, all of that, which help their cost structures. And think about most of these, all of these are likely to have bottomed or probably potentially going in the opposite direction. We have been hearing discussions about increases in tax rates in the US again. Interest rates have started to go up, and there is pushback against globalization and the cost benefits that these companies have gotten in the past. So that means the earning support that you've had in the past is unlikely to be a tailwind on a go forward basis. But whereas when you think about China, one, the valuations are extremely attractive. Second, compared to broader acqui markets, Chinese market valuations, this light green line will tell you that they are towards the low end of their history. And they're doing the right
Sujat, maybe
things.
if I could
Yeah,
interject you there, Sujat. So just to maybe on the
sure.
previous one before we went into China. So see, while we understand and just for the benefit of all the audience, right? While we understand that we have the we have the profit margins going up, but there's a valid reason which is more than interest rate cycle, right? Also because interest rate cycle, yes, has helped since, let's say, the crisis of 2008, when rates went too close to zero. But I think, let's say, in the last 2 or 3 years, if you take the recent data when the interest rate cycle pretty much changed, and still you got while there were immediate repercussions in 2022 when the markets fell, but then the rally from there in 2023 and 24 in the US markets has been pretty solid, which was evident from the Max 7 chart that Manisha was showing, right? And it's coming on the back of technological gains. So in your mind, what do you think? That is this technological gain? Does it have many more legs? Is the Nvidias of the world, the whatever the Black Hawk or whatever that chip is called, it's going to really change the things in a big way, and that has much more legs. So are we going to see even more profit margins from the kind of automation and efficiency technology is bringing in, or is it time that now that it has reached a level that because the interest rate cycle has turned again, so emerging markets become more attractive than, let's say, the technological gains and the kind of the pendulum has shifted in that direction. So what's your kind of view or thoughts on that?
Yeah, certainly. So we have also worked on the AI, for example, which has been the biggest technology related driver in terms of gains and all the spending, etc. We've developed a detailed industry model, and we do see that the benefits of using AI servers is real for businesses, and there is a lot of significant runway for increased spending. So the server market, so if you see AI servers are likely to grow like 6x between 2023 and 2030. So you're going from companies spending $50 billion a year on AI servers to $300 billion a year by year 2030. Now, if you think about it, is it possible for companies to spend? So it's very interesting, right? So for a long time, you had global service shipments were close to 12 million, 14 million per year. And the overall industry size was less than 100 billion. And suddenly you have AI servers itself on top of these regular servers becoming such a big pool. So the worry is, who has the money to spend on all of this, and is it worthwhile? So if you look at the cloud companies, just the top four cloud companies, and see what has happened to their capex investment, right? So it used to be close to 120 billion on a combined basis in year 2022. Now that has grown 50%, right? It's now closer to 160, 170 billion per year over the past 2 years. So 25% per annum kind of growth. And the growing revenues. So if you see their business models, the growing revenues anywhere between 10 to 20% per annum, which means the capex spend can also go up at least 15% from business growth, but even more because the capex intensity is going in their business models. They all want to be the first ones to have, to win the arms race, right? So the bigger data center servers you have, the bigger data centers and the amount of AI server chip capacity you have, they think that will give them those additional insights and help win more business. So it's not going to stop anytime soon. But the issue here is, the key uncertainty here is whether they're able to show benefits from this AI spend investment anytime soon. So we haven't seen, any obvious data points that tell us, all of the spending they've done in the last 3 years is worth it. Companies do claim that on the margin, they're able to better direct their advertising spend dollars. They're able to do better in terms of target marketing, etc. Right? But the reality is, if you look at the numbers, what we have seen is, if you think about the amount of money these companies are going to spend over the next 5 years or so, right? It's material, and either they have to cut their costs by 15% or so based on the work we've done to justify all of these investments. So to get a return on invested capital that is appropriate, or they have to achieve 25% incremental revenue growth. So these are not small numbers, but they have 5 years to get there, or potentially longer. Nobody is, putting a timeline in terms of telling those companies to prove to investors. But if they achieve either a double-digit 15% type cost reduction by automating a lot of their tasks, or if they win new business as a result of these AI, related initiatives and new products that can help their revenue grow by 20-25%, they would fully justify all of these investments, and that will likely continue to spend a lot more going forward. So that's where we are. And there is a big question mark whether they can show it or not. But the near-term support is strong. But over the medium to long term, it's questionable, right? The other thing you have to see is also what's priced into these technology companies. If they're priced to perfection, if investors are already assuming that all this spending will be profitable, there's not going to be much wastage, and they're forecasting strong earnings growth for the next decade and reflecting that in current valuations, then the odds are not in your favor. So there is a big chance that there could be disappointments in the returns they can generate on the spending, and that would mean, future valuations, the performance and returns are going to be much different than what we have seen in the past. See, the past has been good, it's what it is, but you cannot ignore valuations and what's on your side. So one good example is, we look at Chinese market, and the index returns have been low, right? They've been low single digits to mid single digits over the last 10 years, last 12 years, somewhere in the 3 to 5% range per annum. But if you actually look at earnings growth. So go back to any year, we've done analysis. We picked the companies in the MSCI China index as well as our own portfolio back in 2016. And you track the same set of companies over the subsequent 7 years, 8 years, and see what has happened to their earnings growth. Chinese companies have been able to grow their earnings at close to 11% per year. Where has all of that grown in terms of returns in the stock market? Right? One, the headline indices are deceptive because there's been a lot of change that has happened in the index itself. MSCI China, for example, went from about 130 names to 800 names today. And especially as the China A market opened up, a lot of the composition of the index has changed. So you might see low returns at the index level, but the underlying earnings growth is much better. So if you own those companies at the stock level, you could have done a lot better, which is what we see in our portfolio too, right? While emerging markets have generated 4.5% returns in the last decade, our portfolio is up 8.5% or so. And that's because that reflects the real earnings growth, underlying earnings growth that these companies have generated. They're not doing as poorly as broad index returns would suggest. You clearly need somebody to separate the good from the bad and do the right stock picking at the market level. Very positive on current valuations and what that means for the future returns in emerging markets, especially China today.
So I just want, out of curiosity, and for everybody's knowledge, if you could also throw some light on how much exposure does Arga EM fund have to China per se, in percentage terms.
Yeah, certainly. So we have close to 45% exposure to China plus Hong Kong in our emerging market fund. And if you go back historically, we are not benchmark investors, right? We are benchmark agnostic. We build our portfolios from using a bottom-up approach. And there are times in the past, for example, like 2015, when Chinese stock market valuations doubled over a 6 months period, etc. Our China weight in the portfolio back then was close to 10%. And there's other times where we have had much lower weight in China. But today is one of those times where the weight is much higher. It just reflects the valuation opportunity to generate superior returns for our clients on a go forward basis. And it is the highest ever, I mean, we've had in terms of the weight of China in our portfolio over the last decade.
Thanks.
And Sujit, let's say the overall overweight position that you're running on China, has it changed of late since you saw the rally and the fiscal stimulus talk and the rate cuts that happened in China? Because China has tried to do a lot of verbal intervention, a lot of stimulus talk, and historically at least under-delivered, but this time what they did was very, very impactful. Still, the market is questioning what they're going to do. So how has the allocation to China changed, let's say, over the last, let's say, 5 years in your mind, and why?
Yeah, certainly. So over the last 5 years, we've added to China materially from 2021, and our allocation peaked in 2022. So if you recall, the peak pain point for Chinese markets came 2022 during the People's Congress meeting when Hu Jintao was pulled away unceremoniously in that meeting, and investors were really disappointed about everything that has to do with China, right? Because you also had zero COVID policies going on even in 2022. So the markets were really bad. And that's when we found a lot of high quality businesses trading at depressed valuations. We're talking about companies that have net cash positions, generating double-digit free cash flow yields, and many of them were actually paying high single-digit dividend yields to us. So all we had to do was own them, be patient, because the earnings are real and they're returning cash to shareholders. And you look at the internet sector too, same thing. All of them have massive net cash positions, generate a lot of ongoing cash flow, etc. So that we've ramped up our allocation, especially to consumer discretionary sector, as travel, all of that was disrupted due to zero COVID. So the travel agencies, online travel agencies like Trip.com, Macau casinos, and home appliance companies, these were all big positions. Since 22, we have pretty much maintained our significant overweight as a result of our bottom-up research, close to 45% or so. Even after the recent policy announcements and the market rally, we haven't changed our allocation much. We think, clearly we benefited from the recent increase, but the reality is the valuation upsides are still significant. So we're not going to just abandon the remaining valuation upside just because things worked out well for a month. One big positive in terms of the Chinese government commentary is about the real estate market, right? So if you see the start of this whole problem started when Xi Jinping said, "The homes are for living and not for speculation." And he has clearly stated that he's not
True.
comfortable with these rising property prices in China, and he
Yeah.
doesn't want people to buy second homes and speculate. This happened like 5 years ago. And that's when authorities started the real estate sector to, um, go into trouble, self-correct, let a lot of companies go bankrupt. But finally, for the first time ever, at the highest level, including Xi Jinping and the Politburo, they've all openly said that they want to draw a line under the property sector. They want to stabilize the property sector. Clearly, it's not as positive as them saying we want property prices to go up. But I'm not sure anybody would say that, openly. And since they've seen how Chinese investors can take things to extreme, right? If you are telling these things. So that's a big positive. The moment they start addressing the issues, excess capacity in the property sector, dealing with ongoing property price declines and sales volumes, that can lead to a big change in the confidence levels of consumers in China. Because right now, consumer in China is facing mostly a confidence issue from the wealth effect, right? So they've seen about 65% of Chinese household wealth is in real estate market. Maybe about 15-20% is in the stock market. So if you add both of them, you're talking about 80% of your wealth has been under constant pressure over the last 5 years, with real estate prices going down and stock market valuations have been poor. So they feel poor, they want to tighten their belts, and they're not spending as much. Everyone is cutting back. And we've also seen the private sector crack down, especially on the internet sector, led to a lot of job losses, salary reductions, etc. Recently, they've done that on financial sector also, where significant bonus reductions have happened. All of this impacts, people see their friends seeing salary going down and some job losses. They see their own wealth going down. This is a very vicious cycle in terms of sentiment and what consumers are comfortable spending on. The moment property cycle turns around and they're not worried about declining wealth anymore, we think that can be a turning point in consumption trends, and materially the broader market in China, how things can perform.
So, sir, let me take a quick interjection here to bring attention to some of the Q&A that has been asked by some of our friends here. I think Amit has asked a couple of questions and also Lavesh. So maybe I'll just summarize and see if that is a way to get some answers. So see, one of the things that what Amit is saying here is that see, China has been a very non-transparent market. right? And they have literally taken this socialism that they want to bring down property prices. It's for staying, it's not for speculation, kind of thing, like you mentioned. And that had an impact. I mean, I remember Alibaba IPO and Ant IPO was happening, and they literally kind of almost business-wise killed, the Jack Ma's aspirations, and then that started, in 2021 and kind of followed up. But given the lack of transparency, what gives you comfort that that should be the maximum allocation, going forward? Taking in perspective that there has been almost a somewhere between a 20 to 40% rally that has happened in the span of, let's say, 1 month, depending on which day you look at it, and still people are very confused that is it time to get in, or what do we do? Because see, there's one. I mean, so there was this statement that the ECB chairman at that time, Mario Draghi, made, if you remember that time, where he said we'll do whatever it takes. That whatever it takes attitude that we've seen from the central bank in Europe from Mario Draghi at that time, and we've seen it from not maybe Powell, but we've seen it from various central bankers that whatever it takes attitude has been there. But I don't know if China is giving that message in the latest stimulus that is coming out, because it always investors always feel that, hey, we wanted more, but it's not coming. And I don't know whether Arga has felt the same. But what gives you the comfort, given the lack of transparency, the lack of communication?
Yeah, yeah.
How do you say that that's the maximum allocation we should go for in EM?
Sure. China, most emerging markets are like that. Okay. It's the level of corporate governance or how politicians do policy making. It is very not that transparent, and you have to deal with all the risks and uncertainties that come with it. China is no different. As long as you understand the intentions, try to understand the intentions behind why the government is doing certain things. So, for example, they've recently said they're ending the crackdown on the private sector, right? Especially the internet sector. The motivations were more to do with making sure that the national security aspect data is in their control as opposed to control of the companies, etc. And they didn't want them to have monopolies in those areas. So they tell you why they're doing certain things. And secondly, if you think about, despite the recent rally, why we are positive in terms of valuations, etc. The Sorry, the question was, it is not that transparent, and we've seen, okay, the stimulus, they're not saying we'll do whatever it takes. I think one of the reasons there is you don't want to recreate the speculative bubble that has happened in property sector again, right? The moment you say that again, they have to resolve it in a gradual manner so that they're not promoting another bubble in property or construction or do the same mistakes they've done in the past. So that's one. And second is, while the other thing I would simply say is, if everyone is feeling good and positive about the Chinese markets and everyone is happy with what the government is doing in terms of stimulus, etc., that's probably a time to get out as opposed to still be invested in the market. So today, because a lot of investors have still doubts, they don't believe in this, they don't believe that things can get better, property sector, eventually the problems can be resolved. And Chinese consumers are again starting to go to spend in a healthy fashion again. That is the opportunity. And why we still like and stay invested is the level of valuation upsides we have, and most of the companies in our portfolio are significant. So you can see our top 10 has a lot of Chinese companies, about six or so of the top 10 are Chinese companies. Gree is the largest AC manufacturer in China. As I've said in the past, I mean, this company has 30% of its market cap in net cash. It has the best brand and 30% plus market share in domestic split ACs. Most of the demand they see is from replacement of existing ACs, right? So things break down and you have to buy a new AC. You're not going to wait around because economy is bad or you're not feeling as positive about the economy. People replace their ACs when things break down. So this is a very stable, high recurring revenue kind of business that is being punished because it has some exposure to the property sector in China. You're getting a very healthy balance sheet with net cash position, and in the long run, China is still underpenetrated in terms of AC penetration versus peer countries like Korea, Japan, etc. So there is growth opportunity, there's attractive valuation, and strong balance sheet that can withstand any near-term demand fluctuations and disappointments. So you have businesses like that. I mean, every single top 10 position in China, and while they've gone up maybe 10%, 20, 30% in the last, since the stimulus was announced, the remaining upside is still compelling for us to stay invested and wait for eventually other investors to start paying attention to the market.
And how are you thinking about Taiwan, right? So we have allocation in the names like TMC, TSMC, and so on, and roughly 10%. And but what happens if China and Taiwan escalation really goes up to the next level? So what are your thoughts about that?
See, that is again, that's one risk that we think is bad for not just China and Taiwan, it's bad for the world in general. And I don't think any market is going to be left alone if there is a war on Taiwan, right? Because US is also closely involved in this dispute, and it's just that that region is so important. China itself is very important for global economy. And then you have TSMC in Taiwan, which again is crucial for the supply chain of semiconductors. If there is any issues with manufacturing, etc., there, it's going to lead to a material recession across the world. So nobody is going to be spared if that happens. The reality is everybody talks about it all the time, which is a good thing, right? This is not a risk that can come and hit you like unexpected. Nobody thought about this, nobody forecasted this. But we think because China is so ingrained with global supply chains, and we've seen what happens when there are issues in China in terms of recent inflation in the developed markets, right? This massive supply chain issues and inflation that caused the problems. And it's going to be a lot worse, magnitude of orders worse if a real war breaks out between the two countries. We think any unification is likely to be, pursued in a more peaceful manner, in a relatively less disruptive fashion. But that's a tail risk that we have to live with. We don't think it is a base case. The moment, if you believe it's a base case or somebody convinces us that this is the base case you have to work with, then you have to be very cautious. But we don't see that we still see the probability of that happening as minor. And that's why we're comfortable investing. Okay. So Taiwan, per se, the valuations there have run up a lot because Taiwan is a tech-heavy market, and a lot of companies are exposed to the AI cycle. And we have been trimming our exposure there, especially TSMC. It's done very well. We've started trimming back, given the remaining valuation upside is much lower than when we initially bought it.
Maybe a stupid question, Sujit, but I don't see names like BYD. Is it just that they are smaller in allocation, or what's the story there?
No, no question is a stupid question, as my boss says. When the research reviews happen, we all are encouraged to ask as many stupid questions as possible. So that's when we actually learn a lot. So BYD, it is relatively attractive, but it is not a value stock. The way we invest is we have a quantitative screen, and we focus on the cheapest quintile of that quantitative screen for fundamental research. Unless a company comes through that screen into the cheapest quintile, we are not going to spend our resources on researching that opportunity. So BYD is not yet in the value investor bucket. It's still a lot more expensive for us than but there are times when all these growth companies become value, right? So we have seen Facebook became value a couple of years ago, and we owned it in our global strategy. And we see TSMC and other growth names becoming value multiple times if their businesses are cyclical in nature. So yeah, it is. Yeah, we stick to our knitting, which is value investing. We don't deviate and chase, attractive stories, etc. So we are trying to take advantage of other investors' overreaction and behavioral biases. So we cannot deviate
Understood.
from our thoughts.
No, that makes sense. So it's, I guess, so basically, let's say if someone wants to play the really high growth momentum overvaluation play, then you may as well be in Nasdaq, right, today, or in semiconductors, in that sense. But here, if you're really talking about value as a good part to kind of balance your portfolio, then it makes sense to get into emerging markets play with at least, let's say one third or 40-50% allocation. May not be 50, but let's say that what you're doing about 37 to 40% into China. And I'm assuming that your allocations change quite frequently. Like, how does the investment committee work? Just to understand, like, let's say, what was the lowest allocation that you had in China before 2022? Like, how does it work? Maybe just an insight into that would be useful.
Yeah. So our investment horizon is, 3 to 5 years, right? So our allocation doesn't change that quickly. So our turnover ratios are in the name turnover is about one third, 33%. So you see here this yellow line. Oh no, this is the market performance. This light blue line is the ARGA weighting to China. Dark blue line is China weighting in the MSCI Emerging Market Index. So back in 2015, we had 10% in China versus index at 26%. That's when the market was, it has done very well and it was overvalued, right? At that
Hmm.
time, we found much better opportunities elsewhere. And we've had, low underweight to China pretty much from 2017 to 2020. So if you see this light blue line is well below the dark blue line, and we've started going into an overweight position only from 22 onwards. It's just because of when the stress is at the maximum, valuations are really attractive. That's when our process points us towards these opportunities. If our research confirms that these opportunities are real, that's when we own them in size. It's not, we're not just buying all the cheap companies in China, right? So we've not bought into any of the, except for one real estate company, we rejected all the other real estate companies in China, even when they screened cheap for the last 5 years, because our research told us they are excessively leveraged and they won't be able to survive a period of pain in the real estate sector. So you have to be selective, do your research and avoid value traps and companies that are cheap for good reason, and buy companies that are temporarily depressed due to cyclical fears or macro worries and things where things can recover over a 3 to 5 year period. So today we think there's a lot more opportunities that are cyclically depressed and can recover on a 3 to 5 year basis in China, irrespective of
Great,
what
yeah.
Chinese government does, pretty much.
Yeah. So there are three questions I see in the Q&A. I think one's from Lavesh and one from Mr. Patil or Ms. Patil. I'm sorry, I don't know the exact person. And then the anonymous talking about PE of China versus 10-year average. So talking about US. So I think maybe I'll just take a quick thing. So we're not talking about moving away from a US valuation into an emerging market. See, a US valuation, let's understand that it's or rather US allocation cannot be a value allocation today, right? If you're thinking value, there is no value, at least in the US tech sector, semiconductor sector, or even the S&P sector, right? It's the Mag 7 which are driving everything. Maybe Russell has some value somewhere, which is the small cap index, or that's a very, very risky index to go into. But anyway, so that's separate. You cannot think of US as a value allocation today. So if you're talking about moving from US to China, it is not a value rotation. It's a rotation from momentum to value that one should look at, maybe, right? So, where you say that we want to allocate from momentum to value more, and hence move from US to either China or the broad EM that Arga kind of offers. So that's the way one should think about it. It doesn't mean that you should not invest in the US. Like whatever allocation you hold, you need to probably trim it because it's already rallied like 20-30%. Whereas China, if you look at a 5-year chart, and maybe Sujit, you can answer that, where is the PE of China over its 10-year average? If you look at a 5-year chart, it's still like undervalued in the dumps. And I was looking at the market value to GDP, right? So market value to GDP for China is like 1/7 of what the US is, right?
Already. Yes.
Yeah, maybe 1/6 now after the rally. So those are the things where you clearly have to find value, which is a very separate, different factor that one looks at than when you look at momentum or a technological gains. It does not mean that you don't invest in technology, but it also means that you need to balance your portfolio. You cannot be having a lunch of gulab jamuns only, right? You need to have some combination of let's say various proteins or vegetables and carbs and so on, right? So maybe on the one part about the PE of China versus average, where it is, and I think you've kind of touched upon that, Sujit. But if you
Yeah.
look at it from a 5-year or 10-year horizon, what is the kind of growth that one can expect, both in terms of, let's say, the price to earnings, or in terms of returns, that one should imagine over the next 5 years?
Yeah, so the multiples, I think on a PE basis have been fairly stable. So when we did this analysis of what's driving the low returns at the index level, we were trying to see if it was because of multiple contraction. So the multiple is low, right? The PE multiple in China is low double digits versus US, which is more than 20 times. The valuation discrepancy is clear, but there hasn't been a lot of compression in that over the last decade or so. What's driven that is at the index level is mostly the index composition changes, etc., as well as earnings, EPS at the index level not growing as much. But we think that's misrepresentative. Individual companies in China have grown earnings at a 10% per year range. And if you remember the chart I've shown where the cyclically adjusted P in emerging markets broadly uh, is uh, is at the lowest end it has been in the last 25 years. And it's at 10x today, 10 times cyclically adjusted P. And historical relationship implies that if you bought at this level, you're looking at low double digit returns for the next 10 years on a subsequent basis. So similar to what you would have gotten during the dot-com bubble and Asian financial crisis time periods, where we've seen that for the next 10 years.
Got it. Sounds good. Thanks for that. So in terms of what are the other markets that you within the emerging markets other than China? I'm sorry, I'm conscious of time. Maybe this is the last one I'll take. Other markets that one should look at, focus on within the emerging market space outside of China.
Yeah, we find a value today in Brazil and Thailand, South Africa, South Korea are a few of the other markets where we find a lot of opportunities.
Okay. And these are markets where you would cap your allocation at a particular level, like you'll never go like 40% into those, right? Because it's probably linked to the GDP or
Yeah, they're much more
uh,
smaller markets, so the liquidity of the markets and the available number of opportunities is much lower than China. So we can be materially overweight, but unlikely that go to 45% level. So Brazil, if you look at it, we've probably been closer to 17%, 20% of our portfolio at peak. Um, Today we are probably at around 12% or so in Brazil. So, and much lower in South Africa or Thailand, you probably never go about 10% also. Just the number of companies and investment opportunities more narrow in those smaller markets.
understood.
South
Understood.
Korea is
Thanks.
very deep, and that was about 20% for us. for many
Got it.
years. So
Great, thanks. Yeah, I think there's a question from Asit talking about China versus US small cap. So very different markets, and US small cap typically has a higher PE, but it's almost at a double PE of what China is, if you think about that. But if you compare to the technology guys, it's at a much smaller ratio over there. I mean, so correct me here. So China must be at like the CSI, let's say, must be at a 15-ish 12 to 15-ish PE, right?
yes,
But the US small cap will be like at a 25, 30x, I mean 25 to 30 PE, whereas the S&P is probably trading at 20-ish odd, right? So very
right.
different segments, and it kind of it models up based on the because the companies are very large sized, in different segments. But yeah, maybe this chart kind of explains that more. But clearly, I think the point I'm trying to make is that it's when you compare US small cap, it's typically compared to the US large cap or the S&P or the Nasdaq, whereas China is clearly a value-driven play, and it's even at half the valuations of the US small cap, that we are seeing today. So it's quite interesting. I think both the segments are quite interesting today. Yeah.
Sure.
Okay, Manisha, over to you. Yeah. Sorry, I
Yeah,
think I
I think
overshot.
we've taken, I think we shot up a little bit, but I guess we are
No,
still able to cover a lot of, the queries that people had. And thanks a lot for adding value here. So thank you all. I mean, yeah, you joined our webinar, and I think I really hope that the outlook for 2025 is clearer, and you truly made this engagement a success today. Special thanks to our panelists, Ashish and Sujit. Really, thank you very much for sharing your valuable insights, and also acknowledge, the organizing team for the hard work that they've put in. So looking forward to any queries that you all may have further, and you can write to us at support@crystal.ai or get in touch with any of us, and we'd be happy to address any queries and help you with your allocations. As always, looking forward. Thank you so much.
Thank you.
thank
Thank
you.
you, Sujit.
Thank you for having
Thank you, team at Arga. Thank you, everyone. Thanks, everyone, for attending. Thanks, Manisha.
Thanks,
Thank you.
Pankit. Thanks, Namit.
Thank
All
you.
right.
Have a good
Bye-bye.
evening. Yeah. Bye.
Good evening. Bye.